Hello there, everybody. This is Craig at Max Trading. I'm here along with Eusebio, and it's really a pleasure to welcome you to our real-time trading session today. We do appreciate you choosing to spend a little time with us, and we'd also like to extend our best wishes to you and to your family and your friends for health and safety during these very frustrating ongoing months of virus problems. If you like to trade the trends in stocks or Forex or futures or some other market, then of course you need a very effective trading system, and Max is the very best in trend following systems. And we also provide you with what we are pretty sure is the best training available, and classes do begin next week. So this is a good time to be taking a look at Max, and we want you to have an opportunity to see the system at work in real conditions, real-time charts, live trading. As you know, there's no way, unfortunately, to predict the price action on any given day, but we're hoping it will be good for this session. If not, then Eusebio may decide to force a trade, which simply means that he may enter a trade that Max traders would not normally enter. In other words, it's a trade that we know is too risky. It does not measure up to our entry rules. But the trade is entered anyway, just so that you can see how Max methods protect the trading account and take advantage of any potential profit that the market may provide. I hope you will please remember this is not a trading room. We are not providing trade calls. Nothing you see or hear is to be taken as entry or exit recommendations. All of it is for educational purposes only. Eusebio is ready to lead us into the charts for this session. Some of you here today have not met Eusebio before. This is your first time, and you're going to quickly discover that he is a very knowledgeable, highly skilled trader and a good teacher as well. He really enjoys helping his fellow traders, and I think that's one of the things I like best about Eusebio. He is very good about helping others, so I hope you're in a place where you can listen and watch carefully. You'll learn something as we go through the session today, and please feel free to ask questions anytime. Just use the question panel in your GoToWebinar window. The methods that you will see today are those taught in the Max courses, which begin next week, and we provide very nice discounts for those like you who have taken the time to either attend or to watch the playback video. So Eusebio, I think that's enough preliminaries, and we're ready to get started. Thank you for sharing your time with us today, and the microphone is yours.
Thank you very much, Craig. Hello, everyone. Welcome to this presentation, this live session with the Max ETF primer level. I will use the Max ETF primer level today. I will explain in a moment. So, as Craig has mentioned in his short introduction, the Max is a trend-following system. And when we consider trends, so we may consider any time frame, and I like personally to trade in the 5-minute time frame because it is in a small time frame that we may have most of many opportunities every day, but the Max can be applied to any time frame. However, when we trade in a small time frame, and by small time frame I mean from the 1-minute time frame up to the 1-hour time frame, we have to pay attention to a certain number of events or information. If I take a chart, any chart, I will take, for example, the pound card, and I will explain why the pound card in a moment. So you can see on my chart I have some indicators and I have some vertical dotted lines. The orange dotted vertical line represent the open and the close of the usual market session in the Forex. So we have the Frankfurt Open, we have the London Open, then the New York Open, the Wall Street Open. The Wall Street Open has sometimes an effect even in the market. Then we have the Frankfurt close and the London close. I have not mentioned, if I zoom out my chart, the New York close because it's the end of the day or the opening of the next day. And I have not mentioned the Tokyo Open and the Tokyo close because Personally, I don't trade during the Asian session. I live in Europe, in France, and so the European session is for me perfectly adequate to trade. But then you see also some vertical lines. You see here two vertical lines with a comment. These vertical lines in red represent news release. And these news releases may have an impact in the market. The first one is the Bank of Japan overnight rate, monetary policy report and rate statement, and then 1 hour and 15 minutes later we have the Bank of Canada press conference. And because it is the overnight rate announcement, so I don't think there will be a change due to the context, but if there is a change, this may impact importantly the CAD and all the pairs containing the CAD, or possibly, but I don't believe that some other pairs, because the CAD is one of the small currencies. So, but sometimes an interest rate change may impact many other pairs, even the pairs not containing the currency, the related currency, the CAD in this case. And so the news will come now in 7.5 minutes, as you can see on the clock. The news is at 10 New York time. And so the rule we have is when we are in a trade, when the news is due to be released, 15 to 30 minutes before the news release, we close the trade. We do not want to be trapped in a bad movement. Sometimes the movement due to a news may be in favor of the trade, but sometimes it may be against the trade. And if it is against the trade, it can produce an important possible loss. So we do not want to be trapped in such a counter movement. And so the rule is 15 to 30 minutes before an important news release, we close any open trade. If we are not in a trade, and if a trade entry setup appears before the last or during the last 1 hour before the news release, we skip that setup. Now, a setup may appear after the news release, and so depending on the news, so we will consider to take that setup or not, or in which direction we have to take that setup. So we have the news now in less than 7 minutes, so we can wait quietly and see what the news will be, and then react in agreement with that news. On the chart, you see some indicator. On the main chart, you see, for example, a long-term moving average in blue aqua. It is made of 3 lines, and these 3 lines are called the home base channel. The middle line is called the home base. It is approximately a 200 exponential moving average. And then you see a combination of 2 lines in yellow and in orange. They represent a very sophisticated type of moving average. It is not exactly a moving average, but a more sophisticated one. And they are very regular, and they nicely are nicely close to the price action itself, and they are called the max ETF lines. They play an important role in defining the entry setup we consider within the max. And then we have some other smaller indicators which are less important, but which are still important for some purpose. And one which is extremely important is that pink and blue line, which are called the max price channel, which will help us when we are in a trade to adjust the risk we take on the trade, so to adjust essentially the stop loss along the trade. And then we have a momentum oscillator in the first indicator window, and a companion indicator in the second indicator window. The oscillator is called the RSI. It is the stochastic of the RSI indicator, and it is mainly used for our exit setup. I will not explain the detail because all the details are explained in the course. But an exit setup, what is an exit setup? I will explain in a moment. And what is the difference between an entry setup and an exit setup? And the companion indicator, which is also a technical indicator, especially the green and red one, represent the direction we have to trade. When the slow bias, this line is called the slow bias, is green, we will have to consider technically, at least, a long trade, and when the slow bias is red, we will have to consider short trades. But this is a technical indicator giving the direction we have to favor for our trade. When we consider to trade with the max, we have to consider 3 aspects, as in any serious trading system. We have to consider the technical analysis of the price, of course, which helps to time the entries and the exits. Then we have to consider the risk associated with the trade. What is the risk we accept to trade, and how do we size the trade, so the size of the trade we are taking in relationship with that risk. And then the third pillar of the trading system is the global context. What is the global context, and in which direction, based on fundamental analysis, macroeconomic analysis, and so on, should we trade, in fact. And if I consider the pound CAD for the moment, my bias, which is not a very reliable bias today because we have the news, first of all, is the bias is to the upside. So we should consider fundamentally long trade. And so we will consider only when the slow bias is green, and we will ignore all the short trade, at least for the moment. We will have to wait for the news release. If we consider, on the contrary, a pair like the pound US dollar, the context for the pound US dollar is to trade short the pound US dollar because we have element weakening the pound and element strengthening the US dollar in terms of macroeconomics and in terms of geopoliticals, in terms of fundamentals, and so on. And you can see that then technically with the slow bus we can take nice trade in the direction of the global context bias. So this bias can change, of course, with the news release we'll have now in a few minutes. And so let's wait now 2 minutes, and then I will continue to explain what we have on the chart, whether we are or not on in a trade or not. You can see also horizontal lines. These horizontal lines in different colors. The colors are not important by themselves, but they represent possible level of supply and demand level in the price action. You can see, for example, that this white line was a nice supply level where the pound US dollar has nicely reversed, and then we have another intermediary supply level here where the price has paused, first of all, for an accumulation of short position before the price has broken to the downside. So these levels are possible supply and demand level, and they are established every Saturday, so every weekend. So these levels have been established last Saturday. So we are, and they are valid for the entire week, in fact. So these are the main elements we have on our chart. Then when I say we have an entry setup is a set of conditions which allows to open a trade. And the conditions are explained in the course, of course, and we have different types of entry setups, and we make the distinction between an entry setup at the very beginning of a trend, a new trend, and setups later in the middle of a trend as a trend resumption or a trend continuation. And then we have the exit setup. The exit setup are also conditions to close partially or totally a trade. It depends on the situation. So, and these exit setups are of several categories. There are several types of exit setup. Exit setup based on indicator like the Stochastic RSI, but also based on pure price action, based on timing consideration, based on movement invalidation or trend reversal, and so timing aspect as I have just mentioned. And an exit setup has the aim to consider any action we have to take to control the risk we have under it. But it's time to check what the news is. So I will switch here on the pound CAD especially because of the news, and let's see on Forex Factory, so what the overnight rate change, the overnight rate will be, if there has been a change or not. The forecast is no change, and most probably, okay, as you can see, no change, so in the overnight rate. So the overnight rate has been set as established. Now, if you want to have a more detailed explanation of the decision by the Bank of Canada, you can always read the statement, and the statement will be made very soon available on any website. You can see it is already available, so monetary policy report by the Bank of Canada, and if you want to read the decision, so you can always click on the link the calendar gives you, and so you can have the entire comment, and you can follow in 1 hour and 15 minutes, so the press conference. You can say the Bank of Canada will maintain current level of policy rate until inflation objective is achieved, which is not obvious for the moment in the coronavirus context. Recalibrate its quantitative easing program. So if you want to have more detail, you can read here the comment or further comment when the statement will be established. You can read the complete statement by clicking on the link here, which is a PDF document. But what I can see on any currency meter, you can see that the CAD is losing strength, the pound is gaining strength, so the pound CAD stays to the upside, as my bias was explaining, was established. So, and I can give you an idea what the bias are. We have, for the max team, or the max member, but also for the non-max member, so through monthly subscription, we have, so day trade bias, which is based on different types of elements. This version of the bias, which is called the max advantage bias, and it is a short-term one, is generated automatically for the moment. I will not explain the detail here, but you can see that the pound CAD, the pound US dollar is still to the downside, the pound CAD is to the upside, the pound Kiwi, the pound Aussie are to the upside, the euro Kiwi, the euro Aussie to the upside, and so let's consider the pound CAD, so to the here pound CAD to the upside. And the importance of the bias is given by the number of arrows, 1, 2, or 3 arrows, and the direction and the shape of the arrow giving the direction. So up green arrow means an upward bias, down red arrow means a downward bias. So the news has been neutral for the CAD. And so we can consider going long indeed on the pound CAD. And you can see that there has been a spike, an important spike with a big candle. The candle has not closed yet. So it's a kind of disappointment, in fact, for the CAD. The spike is almost 75 pips and the bar has not closed yet. We have still 1.5 minutes before the candle closes. You can see the price seems to pause around this max price level, which was so a possible supply or demand level for the pound CAD. We have anyway to wait for the bar to close, because when we have such a big spikes, in fact, depending on the nature of the news, the price action has the typical behavior. The first step is just with the news release, there is generally, if there is a reason for the price to move significantly, there is a big spike in the direction of the news. So the news was not positive for the CAD, so, and recalibrating the quantitative easing means most probably putting more money in the market, so this should weaken the CAD normally, and so this is why we have this spike to the upside. Going upward for the pound CAD means that the CAD is weakening and possibly the pound is strengthening. Then the second step is the price retracing, and the retracement can be along the same candle before it closes or on the following candles, and the retracement can take one or several candles. And then the third step will be usually what we call the fundamental movement, with the price resuming the direction of the first spike. Sometimes before the spike we can have some speculative movement in one direction or in the opposite direction. But because we are never in a trade at that moment, so we don't pay attention, we don't specifically pay attention to the speculative movement. They may be interesting to observe in some circumstances when we expect the market to anticipate. This depends on the news, to anticipate what may happen. So, but the three steps is what happens most of the time when there is a reason for the price to move. This is the case, like for example, there is a big deviation in the news release. Now, William is making an excellent comment. So looks like pound news and not CAD. But if we look on the calendar, so let's go back to the Forex Factory. So we had the news on the CAD. There is no news on the pound for the moment. Of course, the market does not move only based on the news. There may be some other event. I call them geopolitical events. And to have an idea if something has been said about the pound, we can. Yeah, of course, William, I completely in agreement with you. I see in my currency meter, for example, that the pound is strengthening. And so there should be a reason probably linked also to the pound. And if we look on some other event, so for example, we can see in the news panel of the Forex Factory calendar, if there has been recently some information about the pound, which can influence the pound. So we have here the Bank of Canada, this is the Canadian dollar, France is preparing to announce stay-at-home order this week, so it has nothing to do with the pound. And so we see in these headlines nothing about the pound, but this does not mean there's not been an event about the pound. There are other medias we can check, and I will not have the time to show that here now today, but there are several websites you can consult. For example, the website of Reuters, Bloomberg, you can consult also the New York Times, you can consult the Financial Times, especially for the pound, to see if something has been said, probably in the context of the Brexit, which may influence the pound in this case. And so probably there has been something but which is not yet known for us retail traders. If we see the pound strengthening, and indeed if we check all the pound pair, and it happened that my 6 pairs, 4 out of the 6 pairs I'm showing on my screen are related to the pound, so we can say that they are all going upward. So the pound is getting strong. So there is probably a combination of these two events, the CAD announcement, so some disappointment on the CAD, and something perhaps positive on the pound. Perhaps someone has said that the chance for a deal Brexit are not so good because the big boys are still betting for a no-deal Brexit. Maybe Boris got a haircut. That's fun. So, and this is why, in fact, if you see such kind of phenomenon, and when you have time, it's always interesting to check what is the reason, because this helps you to understand why the market is moving in such behavior. But in the meantime, if we don't have the information, so we have just to accept what we are seeing. So for the moment, the only objective fact is a weakening CAD. So, but it happens also that these movements we are seeing on the pound are in agreement with the bias our website is establishing, and I can show you that again. So the max advantage. So we have the pound Kiwi, the bias is to the upside, the pound Aussie to the upside, the pound US dollar. Oh, this should change in a few minutes. The bias on the pound US dollar will change in a few minutes, most probably, because the trend has been to the downside, and the pound CAD so to the upside. If we take a look on the pound US dollar, we will see that for almost the entire day, so the pound has been moving downward, and we can say this seems to be a deep pullback. Will this pullback continue to the upside? If this is the case, the bias will change to the upside. Okay? Yeah, Robert, it may be possibly some news about the Brexit, and sometimes it takes time for the media to be updated, and so this is why you have to check from time to time what is happening. Okay, here 1 minute ago, Brexit talks have made progress with deal possible by early November. So, and so this is so a news which mention some possibility, but deal possible. So this is still not sure that a deal will be possible. So, okay, and so we will see if the strength of the pound will maintain to the upside. In which case, this would mean that now the big boys are betting for a deal Brexit. Up to now, they were betting for a no-deal Brexit, but they may change their opinion depending how the negotiations are progressing, because the time limit is approaching. You know that it is considered that for any deal to be applicable on the starting at the 1st of January, the deal must be established maximum at the end of November, because they need 1 month to implement the deal. And so the timing is now very, very important. And we can expect any surprise during the current months of November. November will start in a few days now, so next Saturday. So anything may still happen. So we have a nice combination here between the pound and the CAD. And so we can consider indeed a long trade, in fact, in the pound CAD if we want to trade the pound CAD. But we can consider also any long trade on the 3 other pound pairs, but also on the Euro Kiwi, the Euro Aussie, which are also pairs we are advising today. How do we do that? So on our website, and it is a free information we provide to everyone who are interested with this information. So the web page is www.maxtradingsystem.com/newswatch. And so we establish every week, we update every week this page. We give some important geopolitical elements we have to consider. Then we have a simplified calendar in which we mention only the news which are really important. And we make the distinction between 2 types of news which are labeled as major, which are the news which, in case of a surprise, may really affect the market, and some news which are simply indicated as to monitor, which are news, in the case of a surprise, will produce simply an additional volatility in the market. And so not all the news are established. For example, here for Wednesday, we had essentially the Bank of Canada rate statement, and later in the day, so the Bank of Japan policy rate. And so we have then another segment which established the most moving pair, the pair which are the most interesting to trade in terms of trend trading. And then we have for each day of the week the pair we recommend, which provide the pair with the highest probability to see interesting movement to trade in terms of trend trading as always. So, and these information are updated every weekend, every Saturday or Sunday, and then a list of alternative pairs for those who are interested with more with slower pairs, with sometimes more regular movement, and some indices also we can follow. There is an explanation how to interpret the information we give, especially in the calendar. So you can access that page very freely. It's very free of charge page. So just use the link and you will access to that page. So now let's see if we have, so after the volatility of this event have settled down, and we can observe that by the size of the candles, by the nature of the candles, when we have long bars, when we have long wick or long tail, this means that there is still some volatility, but as soon as the bars are again normal bars, so we can say the volatility has settled down and we can wait for an entry setup. So, and let's see now on the pairs if we have an entry setup. An interesting entry setup could be here in the Euro Aussie. The Euro Aussie, we can say the Euro Aussie is going upward. The price has made some pause around this max price level, and then has continued to move up. So I need to wait for an entry setup. An entry setup is a specific pattern we need to see in the one of the specific price pattern we have within the max. So we have to wait. We have no setup for the moment. On the Euro Kiwi, we still have to wait for a setup. The price possibly will make a small pullback, giving possibly a setup. So we have to wait. On the pound to $1, the price is making a pullback. Will this pullback be enough to give an entry setup? Yeah, Probably, yes. In the pound CAD, a setup is forming. We will have to wait for the close of this candle here in 4 minutes, and if this candle, but it is not a valid setup because the pattern is not appropriate for a valid entry setup. Let me get rid of these lines. And in the pound US dollar, so now we are seeing the formation of a pattern. The pullback has been deep enough to give a valid setup if a setup appears. So the pound US dollar will be an interesting pair to follow now. The pound Aussie, we have no valid entry setup forming, and the pound Kiwi, no valid entry setup forming. So the most promising for the moment is the pound US dollar if this candle closes as a blue candle. If it closes as a blue candle, we will have to check if it fulfills all the conditions we need to see that candle as a valid entry setup. So, and we'll have to wait for 3 minutes. So. Now, when I see a comment in a news media like possible deal or progress are made for a possible deal, so I'm always very, very prudent with term as possible or potential, because very often that information is simply an opinion by someone or by a group of people, and I'm extremely prudent with the opinion of people. So this is why we have rules establishing what an entry setup is. We need to see some confirmation about what is happening in the price action. Now, in around 1 hour, in 1 hour, a little less than 1 hour, 57 minutes, we'll have the press conference by the Bank of Canada, but usually what we observe with the different central banks, the press conference does not change the bias. A press conference simply introduces or creates some additional volatility, but nothing serious to change a direction bias. Now, let me give you the moment, the time we are waiting for an entry setup, the opportunity to explain how we consider the exits. So, and I will illustrate it with the pound US dollar. I have said that we have, as exit techniques, exit setup, several types of exit technique. We have exit technique based on indicators. An example of an indicator is this stochastic RSI or STO-RSI oscillator. A typical type of exit technique with such an oscillator is when the STO-RSI makes a divergence. What is a divergence? And this is something I will explain a little more in details in our presentation Saturday. And by the way, you are all invited for that presentation. It will be at 3 p.m. New York time. So a divergence is when, for example, in this downtrend, the price is making lower lows, like in this low here and this low, and when the STO-RSI is making higher highs, we can see that the second high is just a little bit higher than the first high. So we have a divergence, and there are several types of divergences. So, and the candle when this divergence appears is this one, and I will use here the conventions we take to note a potential exit setup. So this happens on this candle here, on this blue candle. And so this candle is called an exit setup based on technical analysis. And in fact, when the conditions are fulfilled, and in fact the conditions is not totally fulfilled, it is fulfilled on the following candle, we have then an exit setup, and if the price confirms, so we can make an exit. If we are in a trade, we can make an exit in this area. And we can close the entire trade, or we can close partially the trade. In fact, whenever we consider a trade, at least with the MaxETF primer level, each entry is considered as made of 2 units, so 2 halves if you want. The size of these 2 units are based on 2 aspects. where we place the stop loss and the risk in terms of percentage of the trading account we consider for that trade. It may be 1%, it may be 2%, for example. And so the size depends on that risk and on the stop loss size. The stop loss is an important concept for the risk management. And so, in fact, an exit setup based on an indicator or not is simply a way to quantify when the risk becomes too much important, and we have to consider how to reduce that risk. What is the risk, in fact? When we are in a short trade and we see the price beginning to retrace, what does this mean? If the price was initially moving in favor of the trade, we are accumulating some potential profits. But as long as that profit is not banked, as long as the trade is not totally closed, this is only a potential profit. When the price begins to retrace, this retracement, and we can never predict in advance how far the pullback will be, it may be possibly a trend reversal. So this pullback, in fact, reduces the profit, the potential profit we can make. And the question is, how much profits can we accept to sacrifice before taking an action? And this depends on each trader. In fact, it depends on the risk aversion each trader may have, but at some point we have to define when the risk is becoming too much important and then take action to reduce that risk. And this is why when we have an exit setup, sometimes we will make the exit, sometimes we will not make the exit. For example, here we have another exit setup. In fact, in this case, this blue candle is also an exit setup, but this exit setup has given no action in terms of closing partially or totally the trade, simply because the price has not confirmed, in fact, the fact that the risk was increasing due to that retracement. And so we have, in such a way, so exit technique based on indicator, but we have also exit technique based on pure price action. An example in this sequence of the downtrend is this red candle, and I will explain that also in the presentation next Saturday. This candle is qualified as a long bar in direction of the trend, in direction of the short trade, and so this long bar is also an exit setup. Why? Because very often a long bar, and statistically 2 out of 3 times, a long bar is followed by a retracement. Sometimes a long bar is followed by a continuation of the trend 1 out of 3 times, and this depends if there is, in fact, some continuous buying or selling pressure following the long bar. It depends, in fact, of the trading activity. But for us, we consider that the long bar is an exit setup. So this is an example, one of the examples of the exit technique based on pure price action. We have other types of exit setup based on pure price action. Here we have a nice one, for example. I will not explain the details. We have exit setup based on what I call critical time period, and the news release is one of them. And we have other exit techniques. So each of these exit techniques are related to a kind of risk we can face when we are in a trade. And so the exit technique is a way we use to quantify when this risk becomes too much important. Okay? Yeah, the pound tends to make a 50% retracement after a spike, but I do not, William, I do not consider this type of retracement 50% or something else, because this really depends on the condition. If it happens, the retracement will be a total retracement. If this information about the Brexit is not a very serious information, or is not an information given by a very important person in the inside the negotiator team, so this may be perhaps a pullback erasing totally the movement made by this blue candle. So this is why I never really pay attention to the percentage of the retracement. So, but in fact, we very often observe an important retracement. It may be 50%, it may be 40%, it may be 60%. And this is why, by the way, many consider that the Fib retracement are so important. Personally, I don't attach importance to the Fib retracement or to the Fib extension, so the market does not really work on these concepts, even if they seem to work. But for me, it's just a statistical coincidence. So the big boys don't use, or a great vast majority of them don't use fib retracement. And so we can say the retracement continues. So, but this retracement does not change the bias now to the upside for a pair like the pound US dollar. The pound is still pretty much strong. It is not the strongest currency for the moment. It is not the weakest. So we have to wait for the price to resume or the trend to reverse, because this is also a possibility. We may see perhaps the downtrend resuming after this important retracement. I will have a check on the other bed. The pound kiwi has made now a retracement which is interesting, and so we have to wait for valid conditions for an entry setup. This blue bar was itself but it's not very convincing. Let's have a look on the other pair. Oh, this becomes more interesting. Pound Aussie. The pound US dollar we have already considered. The pound card now it becomes interesting. The euro Aussie. Oh, here we had a series of valid setup, but I have missed them. And here we may have another interesting valid setup in the euro Aussie. So I will consider the pound three pairs. So the euro Aussie, the pound card, and the pound US dollar. So for euro Aussie, this is becoming a long bar. So this is not a good setup situation. The pound Aussie may be perhaps the clearest one. Yeah. We have 2 minutes. So what I will use to open my trade is to use a tool we call the Max Trade Monitor. And I have 2 minutes to explain what the Max Trade Monitor is, and I will open it on the pound Aussie. So it is an EA which allows us to execute our trade, and I will use a 1% risk on the trading account. And the Max Trade Monitor is made of 2 panels. One panel with button to buy or sell, so to open or close the position, and one information panel. I have to adjust my stop loss, so I will adjust my stop loss somewhere. Let me see where. The stop loss is a rather large stop loss, so I will adjust my stop loss so here, and it will be, it's a big stop loss. That's not the best situation. So typically for a valid setup, we will have a stop loss around 15 to 25 pips. Here, a stop loss is rather large, so 50, 60 pips, it's a too large stop loss. When the stop loss is too large, it's not worthwhile for the trade to be taken. I would prefer something else, but just to illustrate how we handle the trade, I can possibly take that trade. I will force the trade. Forcing a trade is a trade we have not to take. So 30 seconds, let me show you how this will execute. When the stop loss is below the present price, the button is a buy button. If the stop loss, which is this horizontal red line, is above the present price, it is a sell button, and then we have 2 close buttons, an MX and an XXX. Okay, the candle is closing. Now I will have to define where my entry level will be. It will be around this level here. So it's not an ideal entry because of the stop loss side, but just to illustrate the trade. Okay, the price is reaching my entry level, so I make a buy here. So the trade is opened. The risk is a little less than 1%. Why a little less? Because we make a round off in the trade size, depending on the minimum size the broker allows to trade. If I show the terminal panel, terminal panel, you can see in the trade segment that now a trade has been opened on the pound Aussie, and the size is 20 microlots. Why? Because the trading account is only $9,000. I have taken a risk of 1%, and depending on the size of the stop loss, so the size of the trade is 2 mini lots. 2 mini lots or 20 microlots. This depends what is the minimum size the broker allows to trade. Now that we are in a trade, I will have to explain how we handle the trade. And to handle the trade, we'll have three types of action. The first action is how to make a first close, a partial close. I have said that when we open the trade is considered to be made of 2 units. Let me draw, first of all, a green vertical line to illustrate the entry setup. And the trade was a REMO. It is called a REMO, an ETF, long ETF. Long ETF. It is the name of the setup, long ETF REMO. And I see that one of my indicators is missing. My Bollinger Bands. Where are my Bollinger Bands? B bands, so here. Yeah, we were indeed in a REMO. So now the trade is made of 2 units. Each unit has a size of 1 mini lot or 10 microlots. The first step will be to make an MX. An MX always means in the jargon of the max closing 1 unit, and the XXX consists in closing all the remaining open units, in which in this case it will be 1 or 2 units, depending on the type of exit we have to make. Once we are in a trade, so now we are waiting for an exit setup of any kind of the exit setup we have. So let me see if we have another pair I can consider to trade. We will have very soon also an entry setup on the pound card. So in 1 minute, I will set the max trade monitor also on the pound card. And I will have also to set my Bollinger Bands on the pound card. I have forgotten on this platform to set the Bollinger Band, which plays an important role in our approach, and I will explain why. Now the max trade monitor. So 1% risk. Okay. So 1 minute, and let me establish my stop loss. The stop loss is also a large stop loss. I will set my stop loss so here in this area. 50 pips is a large stop loss, so the trade size will be a small size. But we have not a lot of choices in this case. And the bar has a tendency to become a long bar. No, it is not a long bar. No, it is not a long bar. So we have 38 seconds. So my stop loss is established. Okay. I will define my entry level as soon as the bar will close in a few seconds now. Four seconds. Okay, so I will establish my entry level at 767, 767. So right at this, and you can see the price has moved very fast, so I will have to wait for the price to come back a little bit. If the price comes back, otherwise I have missed the entry and I will have to wait for the next opportunity. On the pound Aussie, the price is coming back progressively. I'm going to change the properties of this these two charts to see the price not mismatching with the single bar indicator. That way we can enlarge the area where there is no price. So let's see if we have an opportunity to make an entry here. When the price is moving too fast, which is the case when we have a news release, sometimes it's difficult to be fast enough. And this is the 5-minute time frame. Of course, this is why sometimes we need to be extremely fast. So definitely not, but you see that the direction was a good direction. Now let me explain in the meantime what these information are giving us. The pound US dollar may be perhaps an opportunity to instead. So instead of using the pound CAD, we can use the pound US dollar. Why not? And it seems to be a better opportunity than the pound CAD. Okay, let's take the entry now. So we are in two trades. I never take more than two trades when I make some explanation. So now that the two trades have been open, I will iconize all the other pairs and I will widen the two windows on the two pairs I'm in such a way that now I can give a little more explanations on how we handle the trade. So the two trades have been opened. For each pair we have the button panel and the data or the information panel. So one panel for each pair. We can customize this panel in several ways. So this is explained also in our help video. So in this case, the information panel is giving the following information. We have two columns. One column which is labeled symbol and one column which is labeled global. The symbol column gives the data specific to the trade on the pair we have considered. So the long trade on the pound Aussie or the long trade on the pound CAD. The ESL result information gives the result we will obtain if the price reverses and hit the stop loss. And this number will evolve whenever we will change the stop loss. Either we widen the stop loss or either we tighten the stop loss. By the way, we never ever widen the stop loss. So when we adjust the stop loss, we always tighten the stop loss. So this number, whenever we adjust the stop loss, should decrease. And as long as that number remains a negative number, we can have losing trades. And the aim is to reduce that risk as much as possible. Then the second important information is this XXX profit. The XXX profit is the result we will obtain if we close the trade at the present time. Okay, at the present time. And this result will evolve whenever the price is changing, of course. And it can be negative or red, and it can be positive or green if the price moves in favor of the trade. And then we have intermediary number, open risk, open profit, close profit as a percentage or as a number of pips. The open risk express the remaining risk on the remaining opened units. We may have more than 2 units. If we make a scale-in, for example, which is not the case with the MaxETF Primer, but with the MaxETF Standard, we can make scale-ins. So the number of units may be larger than 1 or 2. We may have, in fact, depending on the number of scale-ins, any number of open units. And so this open risk information represents the risk we have for all the remaining opened units. Then we have the open profit, which represents the open profit on the remaining open units. Closed profit represents the result we have on all closed units. So as a percentage or as a number of pips. We have also the units open. You can see that we have 2 open units now on the pound OZ, 2 open units on the pound CAD. And we have the same information in the global columns, which represent, in fact, the total information for all the trades opened simultaneously. So with the 2 trades, we have a risk of a little less than 2%. And we have 4 open units for the month with the 2 trades combined together. There are other information which are given, for example, what is the distance of between the price and the stop loss for the moment, what is the peak value of the trade, what is the spread, and so on and so on. So we have helping video explaining, or tutorial video explaining all these informations. And we can customize the appearance of each of these information. For example, in the configuration panel, we have a configuration panel. If I do not want to see the global columns, I can uncheck the global variable here for this pair, or I can make it appear. I can decide not to show the information, so I can hide, sorry, this is down here, I can hide the table with this information, or I can make it appear. And I can use summarized label or simplified labels instead of complete detailed labels if I want to have a smaller table. So these are the information given by these 2 panels, and so these tools are extremely useful when we have to handle a trade, especially in the context of scaling. And they help to have a precise idea where we are in our trade. Are still we under some risk? What is the level of that risk? What is the potential profit we are making, or the potential loss we are making if the price is moving in our favor or against our trade? So William asked, are you considering the fact that we are at a major level at 1.8400? Yeah, indeed. In fact, I never consider levels given by other source of information. I prefer, in fact, to define myself what are the major levels, because this is something I do for years now. This is how I perceive the possible level of supply and demand. I never rely on the information given by other professionals. Why? Because I don't know what is their methodologies to define these levels. And I don't care if a level is considered as a major level or not. What I see is, okay, what is the price doing? Because in fact, you can see, for example, here, let's take an example. Let's move the chart in the past. So here. So this is a max price level. Sorry, not that. Where is the max price level? Here. No, I will take something else. I will take the other pair, the pound CAD, because we have other price level. You can see here we have that level of price, okay? And it is a max price level, and which has been established last Saturday, and we can say the price has made a bounce off right on that level. I use a specific methodology to define this level, and we can see that presently the price is reacting in these levels I have also defined last Saturday. But of course, I can never be sure 100% if the price will really bounce off on these levels. It may be simply a temporary support or resistance level, and then probably the price will break these levels. And this is true for any levels defined, whatever the methodology we can use. And so, but having such kind of levels, whatever the methodology you are using, are what I call an attention getter. You get your attention on these levels to see what is the price you making on this level, and to take possibly some decision to reduce your risk or to increase your risk, depending how you perceive the risk. And when you are experienced in the methodology to define this kind of level, you can rely on your own analysis. And when I define my levels here, it is a usage in the MAX to define what I call a MAX mini course, explaining the methodology to use how to define yourself these. And so if you want to do them yourself, you can learn that mini course and you will be able to define those levels by yourself in such a way that you will never depend on someone else. There is nothing more important to be independent for other so-set professional traders establishing some levels or so on. Of course, there are some levels which may be important. If you take, for example, levels given by tools like the market profile, levels given by some approaches related to order flow, or as one of the approaches in the order flow analysis, the footprint. If you are using approaches like, let's say, how do you call that? I don't remember now. We can use several techniques to define these important levels, but you will never be sure 100% that the price will reverse on these levels. But they can get your attention to take some possible decision when you are in your trade, either to make an entry or to make a partial exit of your trade. Okay? Yeah, of course, you can use such an approach, a top-down approach, indeed, and a top-down approach is an excellent approach. This is how, personally, I define also my levels, personally. If you see several colors in these levels, white, orange, magenta, and we have also purple levels or red levels. The color of the levels is not important, but it's a help for me to remember which time frame I have used. And I always begin with the monthly time frame. So I analyze the monthly time frame, then I switch down to the weekly time frame, then to the daily, up to the 1 hour time frame, down to the 1 hour time frame. So I use all these time frame, 1 hour to the monthly time frame, to define these potential supply and demand level. So where the price has made in the past a significant movement, in fact, as a rejection or an acceptance of that level. But you are never sure 100% of the case that the price will still respect such a level. This is why having this level on your chart is important to see what the price will, how the price will react on this level. In this example, when I have made my entry on the pound card, the entry has been made above this level, the orange level, but of course I'm perfectly conscious that there was another level, but the distance from that entry level to the next level was large enough for me to make that entry. And I have to pay attention. If the price reaches this white level, I will have to pay attention to what the price will be doing at that level. Okay? And so these levels are one aspect of our exit technique. They are used for the entry technique, but also for the exit techniques. So now the pound US dollar, the pound Aussie is moving in our favor. You can see what is the profit we can make if we close the trade now, but of course there is no reason to close the trade. So I'm still waiting for an exit setup, so in order to take an action on the pound Aussie, as well as on the pound CAD. And William, if you are used to use higher time frames and to use a top-down approach for your analysis, and I consider it is an excellent approach, I apply myself to define these levels, I will take that opportunity to give you some trick to define if a level is important or not. And of course, the importance of a level, the way I will explain, is not a guarantee that the price will surely react at that level. Okay? Now, let's suppose that at one level, we have on one chart, for example, we have, let's take here, I will draw some line. Let's suppose that in one time frame, we have such level. Okay? Let's suppose this is a level which seems meaningful in the time frame we are analyzing. How to be sure that that level is a very significant one or not? And in fact, A way to do is to consider what is happening on all the other time frames, either the higher time frames or the lower time frame. In fact, all the time frame. And if you see that in all the time frames, that level you have established in one specific time frame is also a significant level, then you can be sure that this level is a real significant one. If there are, on the contrary, one or several time frames where the level you have drawn is not a significant level, you can ignore that level. Because in fact, if a level is a real level of supply or demand, or let's make it simpler, support or resistance level, it will be also most of the time such a level in all the time frames. And so you have in that way a very nice way to confirm is a specific level is an important one or not. Okay? Let me draw another green vertical line on my entry setup. So here, we always note with a green vertical line the entry setup bar and a magenta vertical line an exit setup bar. Now you can see that in the meantime, on 1, 2, 3, 4 bars, now that we are in the trade, that the max price channel is moving upward. And so this may represent possibly an opportunity to adjust our stop loss. We use the max price channel, so this blue line, to adjust the stop loss. And let me show you how I do that. I will use another vertical line in yellow. That way. I put it on the last closed candle, and the max price channel crosses this vertical line on this level. And we are used to adjust the stop loss at a distance between 5 to 10 pips from that max price channel. So I can adjust my stop loss around this level here. So, and you will see how the risk will drop from 0.95% to how much on the pound Aussie. So it was in this area. Now the risk has dropped to minus 0.57%. We have reduced the risk by almost 2. Not exactly 2, but almost 2. And I can do a similar thing here in the pound CAD pair. So the last close candle was this one, and I can adjust my stop loss so around this area, so here, and the risk will drop from -96 to -0.7. So I have reduced the risk by almost 1/3. And the global risk is now only -1.27%. So I have reduced the global risk by a nice proportion. And I can do that bar after bar, checking if I can reduce further my risk. I am almost sure that with the next candle in 30 seconds, I will be able to reduce a little further my risk on the pound Aussie, because the max price channel is going upward. But at the same time, the candle is a red candle, and I will have to check if this candle will not be an exit setup bar. And it seems that it will produce an exit setup bar based on our Stoerzai indicator. Okay, this candle is indeed an exit setup bar because we have again a nice divergence in the Stoerzai. And so here I will make an exit if the price drop at 1700 or 160 here. Okay, I make an MX now, so I close 1 unit. Okay, you see the number of units has been decreased. I have made a small profit on the unit I have closed. It is a tiny profit because my stop loss was a rather large stop loss. But at it you can see that now the risk by making that close has been also reduced by less than 1/4%. So in the worst case scenario, this loss, if this is a losing trade, will be a very small loss. And with this candle having closed, I can adjust a little bit my stop loss, for example, in this area. here, reducing the risk now to minus 0.14%. I am almost break-even now on this pair. In the pound card, if this red candle closes as a red candle, it will not be an exit setup. No, not yet. So we have to wait. But in the meantime, because one bar has closed, I can check if I can adjust my stop loss. And in this case, because the max price now is flat, this indicates that I cannot adjust my stop. Or I can adjust by just a few pips. For example, here, reducing a little further my risk on the second pair and reducing globally my risk. You can see that now for the two pairs, my risk is less than 1%. So I have divided by more than 2 my global risk, my global initial risk. In the meantime, I can check also in my bias, the global context bias, if the bias has changed, which I don't think. So we go on the max advantage bias, and we can see that the pair were the pound Aussie and the pound CAD. So for the pound Aussie, the bias is upward. The pound CAD, the bias is still upward. And you can see the pound Aussie has turned also to the upside. As I have said, so the bias would change most probably to the upside. So my two trades are in agreement with our max bias advantage, which take into account, in fact, the context. When I prepare them manually, so I take into account the geopoliticals, I take into account the news releases, I take into account the central bank decisions, any events, any objective information which may influence the market. When I'm not available to establish these bias manually by a complete analysis, so we have established an automatic bias, which is a very sophisticated technical approach, which corresponds approximately to 80% of the manual bias. And so they are pretty good, they are excellent. And when we take the trade in agreement with these bias, contextual bias, so the winning rate of the max climbs to between 80 and 90%. Now we are approaching the moment when the press conference with the Bank of Canada will be held. This is represented by this red vertical line, so we will have just to pay attention that this press conference will confirm the content of the statement, so no additional information, but the tone the guy will use, and then the answer in the Q&A segment of the press conference, this can create some volatility, so in the market, especially in the pound CAD pair. So we have to pay attention for that, but nothing really significant with the press conference. Normally, a press conference will not change the directional bias. Sometimes it amplifies the volatility depending on the complementary explanation the guy is giving and the tone he's using. Will it be dovish or hawkish? So the specialists pay attention to this kind of behavior. So, and with each closed candle, we can check if we can adjust further the stop loss, which is not the case. So here, so for the moment, we cannot adjust further the stop loss. We have to wait. But if the price continues to move upward, so the max price channel will start climbing again, allowing us to further reduce the stop loss. With the max ETF standard, we have many more exit techniques, and sometimes exit techniques which help us to pinpoint almost the high or the low of a movement, depending if we are in a long trade or in a short trade, which is not the case. I'm using the simplified version of the max, so called the max primer. So I don't use here all the arsenal at our disposal. something I'm observing, and this is one of the exit technique we have, a very important exit technique, calling for an X this time, whatever the number of open units we have, is here in the companion indicator. The companion indicator is made of two indicators, the green and red one, which is called the slow bias, and blue and orange one, which is called the fast bias. And when the slow bias is at an extreme zone, at an extreme area, which is the case here for both pair, and when the fast bias is showing some kind of divergence, which is the case now, so the fast bias is showing a divergence with the price, while the slow bias is at an extreme, we have to expect some trend reversal. And so in this case, if I observe a short entry setup, I will have to scratch my trade. But I will ignore the corresponding new short trade, because this short trade will not be in agreement with the contextual bias. The contextual bias is still to the upside. And so we make the difference between the contextual bias, which takes into account the global context, and the technical bias. The technical bias takes into account only the structure of the price action. In less than 1 minute, this candle will close. So, and in the pound Aussie, I will be able to make a small adjustment in my stop loss. Not a lot, just a few pips. But these few pips will be enough to almost cancel the remaining risk on the pound Aussie pair, as you will see. The potential profit for the two trades are small, and I explain why, because we had an initial rather large stop loss due to the volatility introduced by the first blue long bar, this large spike to the upside. I have said, if you remember, that I was considering the initial stop loss as too large, but just to illustrate the process, so I have taken this. So here, I can indeed tighten a little further my stop loss in this area there, and you can see that the potential loss is only minus 0.1%, so a tiny loss, and globally, so 0.75% for both trades, if both trades must be closed on the present stop loss. If you have any questions, so feel free to put them in the question area, and I will be glad to answer them. So just to make a recap, the MAX is made of three important pillars in our trading methodology. First of all, a technical analysis aspect. We define entry setup and exit setup mainly with technical analysis, with a few different concepts. Then a second pillar is the trade risk management. What is a reasonable risk we can accept on each trade, and how we handle that risk along the trade in order to optimize the result we can exhibit for each trade, either a profit or a loss, because we don't have 100% winning rate, of course. And then the third pillar is the context, the global context. How do we define the direction we have to favor for our trade based on the factor which really drive the market? So the geopoliticals, the central bank decision, the news release, any events which can, in fact, impact the market. And for that global context, we make the distinction between the long-term impact and the short-term impact. The short-term impact is named the market sentiment, and the different factors who drive the market, which drive the market I have mentioned, some of them drive the market on a long-term perspective, and some of them drive the market on a short-term perspective. So they define what we call the market sentiment. If you remember at the beginning, when I had taken this, what I have added the Bollinger Bands on my chart, these gold and green line represent the 2 standard deviation and 1 standard deviation of the Bollinger Bands. The Bollinger Bands is not an essential indicator. We never use essential indicator. Our decision is not based uniquely on indicator. They are just to help us to analyze faster what is happening. But the Bollinger Bands are still a very interesting indicator to help us define what we call the price mode. And our entry setup depends largely on the price mode. The price mode, if I can explain that simply, indicate the present market conditions. Is the price trending? Is the price counter-trending? Is the price consolidating? And of course, you can observe closely what the price action is doing. It's not very difficult. It's clear that when you see such kind of behavior, you can say, okay, for the moment the price is ranging. You don't need an indicator to do that. But sometimes especially when you trade with a small time frame, you need to go very fast. And in order to go very fast, it is when the indicators are very useful. So the Bollinger Band help us to make the distinction very quickly between a trend mode, a counter-trend mode, a consolidation zone mode, a choppy mode, and what we call a spaghetti zone or a spaghetti mode. And depending on the price mode, our entry setups may be different. We handle our entry in a different way. So we don't make an entry the same way in a trend mode than in a consolidation zone mode. Here we have to pay attention because we may possibly have an exit setup. Yes, we have an exit setup with these red bars because we have, for example, a divergence again in the store RSI. We have a top in the store RSI, and so I will have to prepare an XXX on the pound Aussie here at 215. If the price reaches that level, I will close the second unit of the pound Aussie, and on the pound card, I will make an exit here at 9000, or just 1 pipette below on this level. Which is not bad because this will happen, if this is the case, just before the beginning of the press conference. Okay, I make an XXX on the pound card. I could have made simply an MX, closing 1 unit. And I make also an XXX here on the pound Aussie. Closing now the 2 trades. The profit have not been important because my stop loss, my initial stop loss were large, but 1/3% for the 2 trades, just before the beginning of the press conference, which is not a bad decision. So, and now, so what I will do is I will wait for the beginning of the press conference to see if this will impact the volatility of the market. And so after a few minutes, 15 minutes, 20 minutes after the beginning of the press conference, when the volatility will begin to settle down, we can check for another possible opportunity. So, do you by chance personally know Christine Lagarde and whether she is predictable? No, I don't know personally Christine Lagarde, William. And so, knowing if she is predictable or not is not an easy question. So, what I have observed in the past, and which is still valid up to now, is the following fact. The central bankers do not have a tendency to help the market, but sometimes they do. And one of the most predictable example is the Bank of Tokyo. It was a time, and this has lasted for several years, when the governor of the Bank of Tokyo, the Bank of Japan, so with the Bank of Japan, so the Japanese central bank, were asking for the help of the big boys in the market. And so he was announcing in advance its intention to increase or to decrease the interest rates in order to have the market on their side to weaken or to strengthen the yen. And now 9 times out of 10, it has worked nicely. For the moment, and for several years now, they no longer make such announcement. But in the past, these announcements were very, very reliable. I have never seen such kind of reliability with the other central banks. They are vague. They don't give too many informations to help the market. And it's not so easy. It's not so easy to define in advance what their real intention is. But, however, there are ways to analyze some news releases to have a better idea of what their decision will be or can be, which work very nicely. But this depends on the nature of the news release. Not all the news releases can be used in such a way. There are some specific news releases which can be analyzed in an historical perspective. And so sometimes I give this kind of information in our courses or in what I call the practice session. Every Saturday we have what we call a scrolling party. A scrolling party is a practice session. The first part of a scrolling party is to establish the update of our news watch list page with the geopoliticals, the news release, the best moving pairs, and the pairs to consider for each day of the week. Then the rest of the session is dedicated to going through a specific price movement to see how the decision should have been taken. And we use for that not a static chart, we use a tool which allows to replay a specific moment in the market, which is called the FX simulator. And we can do that tick by tick or second per second or bar by bar, depending on the time frame we are using. And during these practice sessions, sometimes I give such kind of information. So. And I explain some nuances we don't have time to consider in the course because the course is limited in time, so it's difficult to consider every nuances. So I explain some of these important nuances during these practice sessions. One thing I can say about her is she will always be on the side of the big, how to explain that? Because I would not like to be considered as a complotist. I'm not a complotist at all, because there are some real facts we have to take into account, but she is on the side of some big, big lobbies, in fact. This is an interesting question, William. What do you foresee the markets doing if Trump or Biden win? This is a kind of divergence I have mentioned last week in our scrolling party, and I'm observing the following divergence. It is an interesting kind of divergence. If we consider all the polls in the mainstream media, they are all, or almost all, telling that Biden is ahead of Trump. And so chances are important for Biden to win the elections. We know that the polls are not necessarily reliable. And many examples in important countries have shown that the polls are not reliable at all. We have seen that for the Brexit. We have seen that for a Trump election 4 years ago, and in some other circumstances. But there is another interesting information I have seen also. You know that bookmakers around the world now offers also for years the possibility to bet on the result of elections. And if you observe all the important bookmakers around the world, they all give Trump winning. So Trump is their favorite. And because the bookmakers put their money on the table, I have a tendency to have more confidence in the bookmaker opinions. Whether I am in favor or not of Trump, it has nothing to do. I have my opinion about Trump, I have my personal opinion about Biden, but I will not give my personal opinion here. But this is what I observe. And so there is a clear divergence between the mainstream medias and the bookmakers. And I observe, and this is objective, I observe that the bookmakers are often in favor, they often indicate the winner, in fact, for the elections. But it's not a certainty, of course. Now, of course, the impact in the market will be different if Trump wins or if Biden wins. And it's even more complicated because this will also depend on the structure of the Senate. If there will be, let's suppose, for example, that Trump wins again the election. Will Trump have a majority with the senators or not? If he has a majority of the senators, this will make, for me, the US dollar stronger. If he has not a majority of senators, this will make his politics a little more difficult. If Biden wins the election and he has a majority of Democrats in the senators, so this will weaken the dollars because it will be a more how can I explain that on a political point of view, a more socialist politics, in fact. If Biden wins and has not the majority of the senators, so it will be more difficult for him. And so the impact on the US dollar will be more difficult to establish. So the impact on the dollar will really depend who the winner will be and the structure of the Senate for the senators' distribution. So it's not so easy to define. So we have just to wait. And of course, we are in an exceptional circumstance for the moment. So we are not only seeing the uncertainty introduced by the presidential election, but we have the confluence with this presidential election with the COVID or with the coronavirus epidemic, whether this epidemic is real or not, because we have pros and cons against all the numbers which are given. And so, but this problem has a deep impact in the economy of many countries. And so the economical situation is another factor we have to take into account. The Brexit is not completely realized yet, so we have another layer of uncertainty. So we have lots of uncertainties, making the market more difficult to apprehend, to understand. So. Our election will be decided by lawyers and courts. If Biden wins, Harris will be president very soon, and she is socialist. We will have to say, there is a possibility that Trump will contest the results. He has already announced that, so I do not necessarily expect to have a fast result. But I think the best way now is to wait, because it's just a matter of days now, and so some uncertainty will be relieved. So just be patient. Just be patient. In fact, whatever the political approach will be, it can be good, it can be bad. Socialism can have positive aspect, but it can have also negative aspect. Liberalism has positive aspect, has negative aspect. It depends how far they are going. And we have seen in some other countries the extremes of these two political approaches. We have seen the best, we have seen the worst. And so where is the right equilibrium? So when big financial interests are at play, so where is the equilibrium of all these political approaches? So I prefer not to give my opinion here, because it is not the object of these presentations. But they will have an impact in the market, that's true. And we can analyze when things are established what the impact may be, of course. Because as a trader, we have to understand these impacts. Because these impacts may give opportunities in one direction or in the other direction. As a trader, we don't need to necessarily worry about the direction of some political approaches. We have to consider what are the opportunities to trade. Now, the impact on our own personal life, in the life of our family, our friend, or the people in the country or in the geographical area, they may have also a deep impact, and this is something else. So now we will have to wait for a next opportunity. So the bias have not changed. I still see the possibility for the trend to reverse in the pound Aussie, but this does not mean that I have a short setup yet. I will have to wait for a short setup. And in the pound CAD, let's see. Well, it's not sure. I have to measure, to make some measurement. We have also some divergences here showing that we may have a possibility for a trend reversal. So it's not impossible that we are seeing now the beginning of the exhaustion of these two uptrends. And by the way, you can see that here we have two important orange vertical line corresponding to the Frankfurt close and to the London close. On the left side, you have another red line starting half an hour before the Frankfurt close, and another red line at half an hour after the London close. When we have such trends we call a true trend, and in the course we define what a true trend is, and such true trends happen between 2 and 4 times per week per pair in general. When such a true trend starts on the appropriate moment during the day, there is a 75% probability for this true trend exhausting inside that time period given by the two external red vertical line. With the following structure, usually there will be, because we are in an uptrend, there will be, and I will take the example of the pound Aussie dollar, there will be a high made between the first red vertical line and the Frankfurt close. It may be right on the Frankfurt close or at the very proximity of the Frankfurt close, then a retracement, and then there will be usually another high between the Frankfurt and the London close, that way, and then the exhaustion. And sometimes the second high will be higher, sometimes it will be lower than the first high. We never know where that second high will be and when it will exactly happen. It will happen generally at the proximity of the London close. This is what is called the London close trade for the retracement which follows. But this is a structure we will often see. And then the exhaustion. The exhaustion can be made of a ranging behavior or some retracement, sometimes indeed some deep retracement, and then a consolidation until the end of the day. But at least the true trend will exhaust in that area in 75% of the case, which means that we are now approaching the moment when it becomes way, way riskier to consider another long trade. Okay? So William asked, I would just like to see the market move with more confidence and not based on insane tweets, red bar, blue bar, red bar, blue bar, craziness. Yeah, William, but you know that the market is made also of human beings. Also, the big boys are human beings, and so they react to what happens, either a tweet or not. Now, you can also consider algorithmic trading. Algorithmic trading represents now a very large portion of trading in any markets, even in the Forex. It is estimated that 80% of all the trades now in the Forex are based on algorithmic trading. But what is algorithmic trading? Algorithmic trading is a set of rules defined by human traders. And so they mimic what human traders are doing. But with one difference, they do that without emotions. So, but they mimic the behavior of a human being. And so they will create the same type of craziness in the market. But it is also that craziness which creates some opportunity. When you understand their impact, so you can have nice opportunity. This is why trading is not simple. You cannot be profitable on the long run by using simplistic rules. You have to take into account many factors. And this is why trading is a serious professional activity. It's not a hobby. If you consider trading as a hobby or as just a small complementary activity to produce some additional revenue, you will have no chance to succeed. To succeed in trading, whatever your trading style, you need to consider the market seriously. And it's perhaps the most complex, the most difficult profession I have had the opportunity to observe. My past career as a software engineer has allowed me to be in contact with many different types of professions. The last 15 years, essentially in the banking area, I can tell you that trading is the most complex profession. So, if trading would be so simple, trading will simply not exist, in fact. Because everyone would be in the same direction, and if everyone is in the same direction, there is no market. And so the best advice I can give to everyone who wants to have some activity in trading is educate yourself as much as you can about the factors driving the markets. And you will see that it's an endless process. There is no ending in this learning process. More you learn, better you understand, but more you learn and more you realize that you have to learn even more. Mihailo, I'm sorry if I mispronounce your name, Mihailo, but the session is recorded and the link will be sent to all the participants. Yeah, it will be sent to all the participants. So don't worry about that. The video will be made available. Okay? You can see that indeed the press conference, Michael, yeah. Ah, you are from Yugoslavia. Oh, that's nice. So you can see that the press conference has created some volatility as expected, but not changing fundamentally the bias. So, and that's normal because during the press conference, the chairman of the board usually don't give more information than in the statement report. He simply confirms the information given in the statement report. You will also all invited to the presentation, the sales presentation we make on Saturday at 3 p.m. So I will give a little more information about what the MAX is, the philosophy of the MAX, some of the concept of the MAX, the kind of result you can expect. So, and so the different courses we propose. And we will propose two of our courses, the MAX ETF Primer, which I have used today, and the MAX ETF Standard, which contain the entire main process with the scaling technique and the scale-out technique. So we have around 7 or 8 entry setups. We have around 20 exit techniques. Now, do not consider that having 20 exit techniques is it's a complex process. In fact, many of them are very similar in terms of concept. They are based on the same concept. And when you understand one of them, you will understand many of them. And so, but they are very, very effective. So very, very effective. Just to confirm what we call the red magic box, all this time window is what our MAX members call the red magic box, when we have a 75% probability for this true trend to exhaust. So we can begin to see that through the Bollinger Band that the price begin to enter into a consolidation zone mode. When the Bollinger Band presents some specific pattern, this indicates that the price is possibly entering into a consolidation zone mode, so the price possibly will begin to range now. In that range, it will make most probably a top around the Frankfurt close and then another top around the London close. I invite you to observe, because in around 10 minutes we will wrap up this session, maximum 10 minutes we will wrap up this session, so I invite you to observe later during the day what the market has made to see if it will have behaved as I have explained. So I will retile all the windows. We can see that the pound Kiwi has moved also upward as the bias was telling. The pound Aussie we have seen, and I have illustrated just a trade at the very end of the trend. So the pound US dollar has reversed, and you have seen in the page in our website giving the bias, so the bias has reversed to the upside. The pound card I have used to illustrate also a trade, so I have taken the trade at the end of this nice uptrend. The Euro Kiwi has continued its uptrend also, and the Euro Aussie has also continued its uptrend. And now they are all making some retracement corresponding to the moment when the price enters into this area between these two red vertical lines we call the red magic box. So when we're in the context of a true trend, so the price exhausts, the trend exhausts in 75% of the case. And in 25% of the case, it does not exhaust in that time period. In fact, in around 12% it exhausts earlier. And we can also identify the situation when the true trend exhausts before. There are criteria to establish that situation, and in 12 to 13% of the case it exhausts later, but the context explains also when a true trend can continue to develop after the London close. The global context plays an important role. So I will say this, says one of you. So with the market in crazy mode, that following the basic information learned in the MAX course has made trading much easier when compared to any other method out there. It is great when the money expended is quickly regained by the information learned. Oh, thank you very much, William. But in fact, if you not neglect all the pillars I have just explained, so it's become really difficult not to become consistently profitable. Of course, there will be days which will be difficult. Some days are really extremely challenging, and believe me, some days I have difficulties to trade myself. Some days I may have up to 10 trades, just trading 2 pairs, 10 trades from the London Open to the London close, because this is my usual trading session, from the London session to the London close. So this represents 9 hours of trading. I may have 10 trades, and in these 10 trades, I have only, for example, 3 winning trades. This is my minimum winning rate up to now, so 30% only of winning trades. This is challenging, because this means that 7 out of 10 trades are losing trades or break-even trade. In general, I have 2 break-even trade and the rest as losing trades. So 5 losing trade, 2 break-even trade. And despite that, because I exploit the trends and especially the true trend in the most moving pair, my day is still profitable. And so this shows, and I have been convinced by that for years and years and years now, that the winning rate is simply a psychological factor, but it's not the main factor to be profitable. You may have a 90-95% winning rate and still fail miserably being profitable, because the 5 to 10 losing trade will make you very large losses. It depends how you handle your trade risk management. You may have only a 30% winning rate and still be extremely profitable. And so the 3 aspects is important. How to define, on a technical point of view, interesting entry setups, interesting exit setups. The second pillar is how to handle the risk while you are in a trade. This means at the beginning of the trade to take a reasonable risk, because after all you can consider any risk. Why not taking a 10% risk on each trade? But I would consider that as insane. It's too much. And there is a reason for that. So we need to take a reasonable risk, and then to handle the risk, trying to reduce the risk as much as possible along the trade until we close the trade. And the third pillar is to take the trade only in agreement with the global context, which drives the market, in fact. And this supposed to understand the global context. And it's the most difficult part, because after all, technical analysis can be made simple. Trade risk management can be made simple. They are simply simple rules-based. But understanding the global context is the most difficult aspect in trading, because we have to understand the impact of some geopoliticals. What is, for example, the impact on the US dollar with the presidential election? What is the impact on the US dollar with the problems between China and USA? What is the problem or the impact on the price of oil, crude oil, or any kind of other oil with the problems in the Middle East? So, for example, the new agreement which is made by Israel with some other Arabian countries may have an impact on the price of oil. What will be that impact, in fact? So this is a typical geopolitical problems which will have an impact in the market, and possibly an important impact. And there are a lot of such geopolitical elements. What will be the impact after the Brexit about the economy in UK, the economy in the European Union, the economy of each country inside the European Union? Because it will have an impact. The fact that UK has left or is leaving the European Union will have an impact in the annual budget of each of other members of the European Union, and not necessarily a positive impact on their economy, respective economies. So, and so on and so on. So, when you understand all these informations, then you begin to understand that the price in the market do not move randomly. And you can have a better idea day after day in which direction you have to get. Of course, you will never be completely informed of what is happening. You will never have a complete contextual or global context point of view. So you will still have losing trade. And even if you are right in your context analysis, you may still have losing trade due to the volatility in the market. But it's not a losing trade which makes a good trader. A good trader is a trader following perfectly with patience and disciplines and perseverance the rule the trader has established. If these rules are serious rules based on the three pillars I have explained. And it's never the winning rate which makes a difference. It's the expectancy of your trading approach, your expectancy, trading expectancy, which will make the difference. If you have a positive expectancy, you will be profitable. Of course, you will have drawdowns, but those drawdowns will be recovered rather easily. It can take sometimes several days, sometimes several weeks, but you will come up with a growing account if you are persistent enough. Because in fact, trading is also a psychological game. And if you do not stand on your psychology and on the right mindset, you will not succeed. It requires some mindset to follow the rules. William says, just look at the bottom of the pound Aussie, so here, and chart, and if one just follows Zillow's green line, so it would have kept you out of some really crappy trades and forecast the future big money move filled with skill. Yeah, indeed. Whether it is the pound Aussie or the pound card, of course, you can consider any of the chart. And so you can see that here, even on the technical point of view, you would have taken only long trades here during that moment, and all your long trade would have been, most of the time, winning trade. It's possible that in all this area, you would have had some losing trades. But if you use the trade risk management in the proper way, all the losses will be small losses. In fact, just to give you, in the last minute we have, let me give you some statistical evidence. If you do not use the global context bias, the winning rate of the max, so the winning rate is around 70 to 75%. Okay? The losing rate is around 20%. It's not 100% minus the winning rate because we have also some break-even trade. Okay? Now, when we have a winning trade, when we use the max ETF standard, so with the scale-in and the scale-out process, the average profit represents approximately between 2 and 3 hours on average. Okay? And when we have a losing trade, on average, a losing trade produces a result around minus 0.5 hour. Sometimes less, often less, sometimes a little above. In some exceptional situations, it can even produce a loss larger than 1 hour when we have made some scaling, for example. But if you again pay attention to the trade risk management, it will never exceed more than 1 hour, in fact, when the trade is closed. And so when you calculate the expectancy of this, so you multiply the winning rate by the average profit and you subtract the losing rate times the average loss, you will get a positive expectancy. If I take 70% with a 2R, we will get, so here, 2 times 0.7 minus 0.2 times 0.5. And so we will get here an expectancy with the smallest number, we will get an expectancy of plus 1.2R, 1.3R, which is extremely positive. And this is what is important, because this will give you an idea of your profitability. Because another factor which is extremely important is the frequency of trade. If you know how many trades you make on average per month, let's say, for example, that you make 10 trades per month, okay? 10 trades per month, let's say that, which is a rather conservative number of trades if you do not trade actively. If you make on average 10 trades per month and you have an average reward to risk ratio, so an expectancy of 1.3R per trade, each month you will have a financial profit of plus 13R. Okay? Each month, on average, you will produce a 13R profit. If you take a risk of just 1%, this means that on average, with 10 trades per month, you will make a 13% profit each month. If you take a 2% risk per trade, at the end of each month, you will make approximately a 26% profit per month. And so this gives you, but this requires for you to use the max, the rule, the concept and the root of the max with patience and discipline. You must never deviate from the rules. Okay? Persistence is important. Persistence is what makes the difference between a good trader and a bad trader, even in the drawdown period, because you will have drawdown period. But the drawdown can be controlled. And in our Max Advanced course, because we have also a Max Advanced course, I teach a specific technique to control the drawdown. We can predefine a maximum drawdown, for example, 15% of the trading account. And if we follow the process I teach in the Max Advanced course, we are guaranteed to never exceed that 15% predefined maximum drawdown. And so we can also control the drawdown, which is something which is counterintuitive, but it is a mathematical problem. And very few traders know that technique. I have never seen someone elsewhere explaining that technique. So, but it's possible. Now you can see that in both cases, the pound Aussie and the pound CAD, so the price seems to now begin to range or to consolidate, and for the moment it's following the pattern I have just explained. We don't know for sure when the high will be. It's possible that the price will make another high around the Frankfurt close, and then it will make most probably another high between the Frankfurt and the London close before further pulling back or ranging. Okay? Oh, Peter, I have not seen your message. It's true that in your country you are in the middle of the night, so I wish you a good sleep. Thanks for the effort to have been present during your night. I really appreciate. So, are there some last questions before we wrap up this session? If you have some question, you can always go on our website, and Craig has mentioned the link to the Newswatch list page of our website, so www.maxtradingsystems.com/Newswatch list. Newswatch. If you use the main address, www.maxtradingsystems.com, there is also the possibility for you to send us an email. So don't hesitate if you have further questions. So we will be glad to answer your questions. We have also a Skype ID. I think it is given on our website, but all this information will be given also in our more detailed presentation Saturday. Okay? Yeah, William, as I say you hello to your Kiwi and cowboy friends. Yeah. And I really appreciate. And I appreciate your questions. So. Okay, that being said, so it's time to wrap up this session. I hope you have enjoyed these 2 hours. Or let me just give you just another small information. You have seen that in a period of a little less than 2 hours before an important news release, we have been able to produce a profit, a small profit, due to the fact that we were late in the trend, of course, but it was a profit. And let me give you just a small here mathematical information or statistical information. If you trade every day, okay, using the MAX, for example, which is not necessarily easy because it depends on your availability, of course. But let's suppose you are able to trade every day, and you are able, whatever the risk per trade you take, to produce a profit, whatever the number of trades you take, of plus 0.5%, so 0.5% profit per day, okay? Which is very, very conservative. If you take 1% for the hour, 1% risk per trade, you just have to make a 1/2 hour profit. So 0.5% profit per day, whatever the number of trade, but per day, and you trade every day of the year. By compounding your results, at the end of the year, you triple your account. It's simply that this is the power of compounding, with 0.5% profit per day, and if you trade every day and you make no withdrawal, and you compound your result, at the end of the year you triple your account. So in 1 year you triple your account. If you are able to make just 1% profit per day under the same conditions, so 1%, which is not necessarily easy because this will depend mainly on the market conditions. But if you are able to generate 1% profit per day, and if you strictly follow the rule of the MAX, you will make that very, very often. At the end of the year, if you compound your result and you make no withdrawal, you multiply your account by 10. By 10. Okay? And this is all I wish you to succeed. So. Yeah, Ralph, I thank you very much. I'm recovering very well. I almost came back to my top level, so the surgery has went very, very well. It was 3 weeks ago, and so I feel nice, I feel good, feel strong, and better every day. So ready to come back to my usual business, so on Monday. So thank you very much for your participation today. I hope you have enjoyed this presentation and the explanation I have given. It is not a course on the detailed course on the MAX. Of course, it's just the illustration of some of the concepts and the rules of the MAX we can apply to consider some trade opportunities. On that, I wish you a good rest of the week. I wish you to be present on our Saturday presentation webinar. Stay well, stay safe, and in the meantime, take care. Bye everyone.